Good morning or good afternoon, and welcome to our webinar, The Value of Broker Deposits, a Key Liquidity Risk Response. Or said another way, taking the mystery out of brokered CDs. My name is Jeff Rigsby. I'm the Chairman and CEO of Finance 500, and I will be the host and participant in today's session. First, I do want to take this opportunity to thank all of you for taking time out of your busy schedule to join us this morning or this afternoon. I know you have a busy schedule, and we will definitely stay on schedule. I think we said 45 minutes, and we'll certainly adhere to that. First, for those of you that may not be familiar with Finance 500, we are a registered full-service broker-dealer headquartered in Irvine, California. For over 25 years, we've been serving the funding needs of over 1,200 banks nationwide. Over the last decade, we've underwritten over $200 billion in broker deposits. In addition to our robust broker-dealer, we also have our performance management group. We are a market leader in enterprise risk management, strategic planning, and capital planning. Together, our groups work together and are dedicated to supporting our clients' optimal performance and risk management priorities. Now, I would like to invite our guests, our panelists, that will be participating in today's session. I do want to say a little bit is each one of us are going to talk a little bit about this topic, but I do view it as a conversation, and I hope you find it easy to follow and insightful. Now, as far as who we have with us, we do have Long Wen, who's the Executive Vice President of our Performance Management Group. Long has also spent close to 20 years of his life as a CFO in a community bank environment. We have Brian Bennett, who is our president and COO of Finance 500 and a founder of Finance 500. And we also have Jamin Ragsdale, who's also a founder, and he's the senior vice president of our broker deposit programs. So with that, let's go ahead and get started. What we want to cover today is we are going to talk a little bit about the current environment, kind of what got us here. And why are broker deposits kind of an interesting topic in today's world. We'll take a look at that. We're going to take a look back at broker deposits a little bit and maybe demystify them or take some of that myth out of it. But let's just talk about what broker deposits have been like in our industry over time. From there, I'd like to take a moment, and Long's going to share a little bit of a regulatory perspective of what the current environment looks like. Then I'm going to ask Brian to join us and walk us through the process of how to set up a broker deposit. How does the program work? What's the mechanics look like? And then we're going to spend the balance of our time, we're going to invite Jamin in and really talk about real world. What do issuance scenarios look like? How does it work? What do we see going on in today's market? And then we'll wrap up with some closing thoughts. Okay, and just before we do get started, to the extent you have any questions, there is an instant messaging capability here. We will also carve out some time for questions and answers at the end of today's session. This presentation material is available, so if you would like a copy of it, by all means, shoot us a note. You'll see Meg's contact information in the back of the presentation. You can send a request through Zoom or give us a call. We will also be recording the session, so it will be available on a recorded version as well. So we do want to open up with just a brief discussion about kind of what got us here. Why today are we dealing with maybe more intense liquidity oversight, more intense liquidity focus? Usually there's a series of events that always lead up to something. So let's take a quick look. And really we have to go back to a pre-COVID environment. And if you take a look at the current chart, you'll notice where the gray area kicks in. That's kind of the end of 2019, Q1 of 2020. And if you think about it, when COVID hit, when the pandemic occurred, a phenomenon occurred in our industry. And all of a sudden, within about 6 quarters, we had $4.5 trillion in deposits surge into the banking industry, literally over about a 4 to 6 quarters. And that is a function of a lockdown, function of stimulus funds, a function of PPP loans. So what we had right off the bat was this surge in deposits, which kind of knocks us off our kilter. And it's worth talking about our industry for just a minute, because when you think about banking as an industry, we live in kind of a happy space. When we're at our best, we have this constructive tension between loan and deposit growth. So if you look to the left of the chart there, you'll see kind of the darker blue line is loan growth. The lower line below that is deposit growth. And when we're in that constructive tension, we are in an optimal performance role for banking. And that's where we are. And as you can see, we roll up into that circled area. That was when the Great Recession hit. And boom, all of a sudden we're out of kilter. Deposit growth goes weird, loan growth goes weird, and we get out of whack. And then what happens? We come out of the Great Recession and we get right back into that constructive tension. And that's just where we want to be. That's when we are at our best. And then all of a sudden we creep up on COVID, and you can see that impact. You can see that deposit growth shoot up, and again, that knocks us out of stride. And you could go back as far as you want to go. We've never had a phenomenon quite like this. And so if you think about it, we were forced with a new set of rules that made us challenge, how do we go forward and grow? How do we leverage this inventory we all of a sudden received? And if you take a look at this chart, we pretty much made a decision. So 4.5 trillion comes in, a little over 2 trillion over the same period of time moved into securities. So in essence, we took ourselves out of that rhythm we're so accustomed to and kind of changed the rules of engagement. So with that, it's now we've got a different makeup of our balance sheet. And then all of a sudden a rising interest rate environment occurs. And so with that rising interest rate, another phenomenon which we hadn't experienced occurred. And these two lines are just really simple: Tier 1 capital and tangible common equity. And you could see going back 20 years, within a little bit of an exception, they run parallel, right? And all of a sudden, boom, TCE drops. And now we're doing our mark to market. We're seeing rising negative AOCI. So all those securities we bought now are adding to a challenge of our balance sheet, right? So that is what brought us to where we are today. So if you were to summarize it, what are we dealing with, and why are we having this discussion about broker deposits? It's liquidity risk has been elevated. If you think about it, the Fed's action to curb inflation through interest rate hikes certainly resulted and led to deposit runoffs, and that required us to move into a more aggressive role of managing our liquidity risk. And with that, we've also seen increased scrutiny around uninsured deposits and large depositor concentrations. Sorry about that. The other factor is interest rate risk, right? It's really interesting. We have this irrational competition on both ends of the scale. On one end of the scale, we have deposit rates going up with rising interest rates. That's good for us. But because there's so much competition in the market, we still have this artificial downward pressure on yields, yet there isn't any governors on the rising interest rate environment on the cost of funding. So we're all experiencing this margin compression, which is leading up to somewhat of an adverse impact to earnings, and probably something that's going to take some time to earn our way out of. And then, when we talk about tangible common equity and dealing with negative AOCI, that's created a somewhat of a conundrum in the capital markets and gets into funding and other aspects of our business. So this surge in deposits really changed our overall operating environment. And then, so that leads us to, so what's been one of the tools in helping us effectively manage our way through? Broker deposits tend to be emerging as a common sense and prudent funding alternative due to this elevated liquidity risk. So that's kind of what got us here now. And so if we switch and say, so what about broker deposits? Many of us have lived in an environment where we are under the impression that they were a sign of either weakness or regulators didn't like it. So let's just take a couple minutes and quickly go through some observations that might indicate maybe it's not all it seems to be. If you think about it, broker deposits have been around for decades, and it's just been part of banking. If we go back 20 years, about 23% of all banks were using some form of broker deposits. Today, it's over 40%. So this sense that broker deposits are unique or different, we've just seen them grow as a practical application tool for many banks over the last 20 years. If we also take a look at the overall deposit levels, broker deposits today aren't quite as high as they were back pre-pandemic, where broker deposits were actually at their peak 3 years ago. They dropped dramatically, obviously, during the pandemic, and now they're creeping kind of back up and being used as a liquidity and funding management tool. If you take a look at specifically the ecosystem of broker deposits, which is run through DTC, this gives you a sense over 20 years. The volume of broker deposits, that's what this number is here, has been in a pretty high number over quite a period of time, but the overall dollar amount was lower if you go back just a decade ago. But if you see that the activity level has continued to remain robust, but what we're seeing is a much larger base. So what you're looking at is a continued growth of the market of what we would call retail broker deposits or retail brokered CDs. What I find kind of interesting when you talk about the myth or wondering about what do broker deposits mean one way or the other, let's just take a quick look at some charts that look at banks that have broker deposits and banks that don't. So that kind of aqua colored chart, those are banks that have broker deposits. The darker gray color are banks that don't have broker deposits. So if we look at something like return on average assets and operating efficiency, with the exception of the Great Recession, banks with broker deposits have basically been earning as much or more than banks that don't have broker deposits. If you take a look at even operating efficiency, they're right in the hunt. Again, with the exception of the Great Recession, their operating efficiency actually over the last 10 years has been better than banks that don't have broker deposits. Kind of an interesting observation when we have this consideration, somehow they're a sign of weakness or something. If we take a look at growth, whether it's loans or deposits, banks with broker deposits have consistently grown at or greater than the pace of banks without broker deposits. Their average deposit growth rate, same, it's been above average and performing in line with, or even in some cases better than, banks that don't have broker deposits. And then if you take a look, which is not surprising, if we look at some of the fundamentals like the cost of funding earning assets or the yield on earning assets, again, if we look at banks with broker deposits, more or less in line with cost of funds, maybe slightly elevated. Banks with broker deposits may not have as much in the DDA range or say lower cost of funds, but on the other hand, their yields are slightly better than banks that don't have broker deposits. So when we take a look at something like average net interest margin, more times than not, banks with broker deposits are at or better than banks that don't have broker deposits. So I really wanted to just take a moment, and there's a lot of hypothetical or theories about broker deposits or not broker deposits, but if you just look at the numbers, you can kind of see that it's pretty unnormalized environment. Now, what is interesting when you look at like liquidity ratio or loan to deposit ratio, arguably banks with broker deposits tend to run a little leaner. And I don't know if that's a good or bad thing, but that's what they do. If you take a look at their average loan to deposits, they run a little hotter there. You can see they're in that average 80s range. Banks that don't have broker deposits are in the average 70s range. So do banks with broker deposits tend to maybe run a little leaner from a liquidity standpoint? It looks that way. Do they run a little higher loan to deposit ratio? It tends to look that way, but certainly we didn't see an adverse impact to their earnings in so doing. And if we take a last look at something like their asset quality and as measured by net charge-offs, with the exception again of the Great Recession, it's right in line with other banks. So, you know, I wanted to take a minute and just share with you as you think about broker deposits. Should I do it? Shouldn't I do it? You know, if it makes sense for you, I guess it's okay to do it, right? What we know is over the last 20 years, up to 40% or more banks are utilizing broker deposits as part of their wholesale funding and their overall funding strategy. You know, generally banks that have broker deposits are performing as well, or in some cases better than banks that don't. So that certainly kind of sets the myth aside that somehow broker deposits are a sign of weakness. When we hear unfavorable regulatory comments, typically it has to do with an adverse condition in the market. And so broker deposits may not necessarily be the root cause, but somehow they come into play. And so there's a perception that they might have elevated the risk profile, but really that wasn't the root cause. They just came in as a latter part of the solution, perhaps. We hear the term hot money, and I think you have to look at that as kind of a misnomer. Broker deposits pretty much are market rate driven. And they certainly can't be withdrawn. I mean, if you do a CD could be withdrawn. You go to Quick Rate, you do a CD, it could be withdrawn. You do a broker deposit, it fundamentally can't be withdrawn. So there isn't somebody that can just sneak the money out like other hot money can. So in short, our experience is that as you look at broker deposits, it's really more of a part of your overall strategy around funding, and it's around your contingency funding. And if you have a contingency funding plan that integrates them, if you have policies that integrate them, and it just makes sense for your overall funding strategy, regulators are pretty comfortable with that. And one last point, from an accessibility standpoint, it's a robust investor market out there. There are more buyers than can fill the orders for deposits. So as you look at sources for funding, you don't have to worry about the broker deposit market coming up short. It's well funded. So spent more time than I wanted to on that, but I did, and before we get into the discussion around broker deposits itself, I want to talk about the market forces that brought us here, that made it more topical, and in dispelling some of these myths. I do want to ask Long to join us a little bit. And Long, would you mind sharing some of your thoughts as it relates to the regulatory considerations as it looks at funding policies and liquidity and things of that nature?
Yeah, Jeff, thanks a lot here. In light of just the recent bank failures, I mean, the regulators have issued this addendum to the interagency policy statement on funding and liquidity risk. This was issued last week, so I hope you had a chance to look at it. But overall, because of the regional bank failures, the regulators, interagency is asking banks to review their contingency funding plan. I mean, I know all the banks have it in there, but you want to really do a deeper dive into what's there. Assessing your funding availability, and then also maintaining a broad range of funding sources. And what I mean by that is, go through and look at your, access the reserve, reserve banking system, the discount window, looking at FHLB bank system. And then if you're a credit union, make sure you leverage that credit union central credit facility. So the regulators are wanting banks to not only go back and look at the contingency funding plan, but also review their secondary and tertiary availabilities. And the key point here is when you're reviewing all those things, to make sure that you recognize the stress involved as well. So for example, tertiary availabilities. I mean, if there's stress in the market, there's going to be volatility, and that liquidity might not be as reliable. So you also want to go test your availability and then also measure those availability, but also to measure to see, can I rely on that going forward as well? And then, of course, you want to fall back on your secondary sources of liquidity as well, which is your FHLB or broker deposits. And so the reality here is that broker deposits can be very stable and very reliable, and it's a good source to manage your liquidity needs. And then I would argue that because the regulators put FHLB and also broker deposits in the same bucket as wholesale, you have to go back and look at it and then assess yourself and go, what would you rather do? Would you rather go and borrow from FHLB and use up that, borrowing capacity, the pledging assets, or would you rather go and just get some additional resources or liquidity through your broker deposits? So these are things you want to do. You want to go through your broker contingency funding plan. You want to document all these things as well, and then support your decision as well when the regulators come in and ask you why you're doing it. Jeff?
Great, thank you, Long. And with that said, let's move a little bit more now towards the process. And we're going to invite Brian Bennett to talk to us a little bit about the mechanics. For those of you, and we did take a look, and there's quite a few banks that are on this call that have never issued broker deposits. So we'd like to take a moment and just walk through the mechanics around getting started, issuing and closing a broker deposit transaction. And by the way, there is a question related to the range of broker deposits and total funding, and I'll get to that question in a minute. So I just want to let one of our participants know I see your question, and we'll get right to that. Take it away, Brian.
Thanks, Jeff. Yeah, I think we've had that question 4 times this week, so that was good. I'm glad you caught that. Yeah, this process is easy. I don't know that it's changed that much in 30 plus years. But it would start with a broker deposit policy. And we have a template. It comes with our introductory package that we can give to anyone who is attending. You'd also like to use that in conjunction with your contingency funding plan. And our performance management group team would love to sit down if you need help to kind of customize that. So you'd start there. Then you'd go to the documentation. So the one agreement that you start with between the bank and our firm is the brokerage agreement. It kind of outlines the process of issuing a CD. It's non-binding. It doesn't make you have to issue a certain amount of CDs or any at all. It's not exclusive to the firm. You can sign other deposit brokerage agreements, and it is very standard language. We've been using Seward and Kissel for about 27 years for our documentation, and they are the originators of this program. So it would start there. You would look that over, and we would sign those agreements, and then you'd be set up with Finance 500. And then the other document to sign is really a DTC document, and it's called the Letter of Representation. And that gets you signed up with Depository Trust Company. You do it once. It comes through their system through DocuSign, and you can review that and some of their arrangements on procedures, and then you sign that, and then that's on file with DTC going forward, and you're set up as a bank to issue broker deposits with those two documents.
Great.
For any of you, Jeff,
No, I was just going to ask you, Brian,
Yeah.
for those that might not be familiar with DTC, can you just
Yeah, we use a lot of acronyms. So Depository Trust Company is in New York. They're the custodian for all securities, including CDs, in the country. They hold them in their either physical or electronic vaults. And this is the way that an investor can buy a CD in their brokerage account. It's delivered through this electronic DTC system, and they're the hub. And so they've been around forever, and this is how all securities or CDs are bought.
right?
So hopefully that helps.
It does.
And then we get to the issuing process. Again, super easy. We would discuss the terms that the bank's looking for, the amount, the different structures, and we'd gather that information and discuss what the costs and things. And once we were on the same page, we would create a terms agreement. It's about a 2-page document, and it's pretty simple. It's going to have things like the settlement date, the coupon, the payment frequency. Is it monthly? Is it at maturity? Other things such as, does it have a call feature, or is it non-callable, regular, straight to maturity? Are we working on a firm order basis or a best efforts basis? The all-in cost will be on there, and simple things like that. So you'll review that as an issuing bank. If it all looks correct, you'll sign that. It comes via DocuSign as well. And then we get to work after we receive that back. And we get to the offering period, which typically is about 5 to 10 business days. But that is flexible. We've raised hundreds of millions of dollars in 3 days. It just depends on the need, but typically about 5 to 10. And that's fast and easy. We do all the work. We start gathering buyers, interest in the CDs and buyers. And then a couple of days before settlement, we kind of tell everybody that we're closing down the issue. We start tallying up all the purchases, and we come to an amount on these CDs. And it could be 1 CD, or you could be issuing 5 at one time, which is extremely common. And that's the issuing process. It's flexible, it's easy, and really we do all the work. Then we get to closing. Just as simple. After we gather up all of the amounts, we bundle it up into a master certificate. It's a couple of pages. It's going to have the same information that was on the terms agreement, but it's going to have the dollar amount. It is instigated or created on the new DTC system and delivered to you via DocuSign, so you can sign it anywhere. It's pretty simple. And once they receive that, then we get to the closing date. So the date of closing, DTC will credit our clearing firm, which is RBC Correspondence Clearing. And they're a division of Royal Bank of Canada. one of the largest clearing firms in the country. They receive the shares and then they wire the money to the issuing bank. And we do net our fee that we charge against the wire. And so that's really simple. It comes directly from RBC. Really, Finance 500 doesn't touch the money or anything like that. After that, it's really straightforward. The issuing bank will send DTC interest payments, and they've come up with a nice way to streamline that. You can send one wire on multiple QSIPs if you have a lot paying on one day. They have a streamlined process, and through their system, the money that received for those interest payments, they're divvied out to all the broker dealers that own portions of those, and then into the customer account. It's all instantaneous and electronic, but as an issuing bank, you just have to pay the custodian, DTC. And so that process is pretty simple. For anyone who hasn't dabbled in broker deposits, we'd love to walk you through it on a one-on-one basis. And even later on, I think we're going to see some examples of real life terms agreements when Jamin gets into it. And we will have an offer for anyone who wants to just test the market. We can do that really easily on just a little, maybe 1 month, 3 month CD for a small dollar amount and get that tested.
Great. All right. Thanks, Brian. Hey, Brian, as long as you're with us on that topic, I'm going to tap you for another one. Would you mind just walking us through, we've been talking about broker deposits, but let's take a look at broker deposits when considered against other sources of alternative funding, right?
Yeah.
And I know this is a relatively simple table. Can you kind of walk us through and kind of broker deposits versus these other things?
Yeah, let's just maybe just an overview. There's FHLB advances. There's other wholesale products. IntraFi has a reciprocal. There's a straight deposit product. I'm pretty sure they have. Stonecastle has an interesting deposit program. And then there's the online rating services. And, really, depending on the circumstance, they all have some capabilities and advantages, and some of them have their disadvantages. So just kind of looking at it briefly, probably one of the biggest advantages, a broker deposit, you don't have to post any collateral like you would with an FHLB advance. That is a big plus in a broker deposit. Something else is the speed. We talked about that. It's typically 5 to 10 business days, but we're flexible. Depending on the urgency, we can advance that. Some of the online rating services, really to gather a large amount of funds, is going to take a while. So when you get into volume and size, broker deposits are pretty good. You're really tapping into the monies that the public is holding in their brokerage accounts around the country. It's vast. So it's almost unlimited how much you can raise, where, maybe going to the online service, that's going to have its limits. The features, the structures are convenient, and there's a wide variety. There's a call feature on broker deposits. There's features where we can do step-up CDs in certain environments that prove themselves to be really good with a call. Some of the other products have some of those features and some don't. So you just gotta look at those things when you're considering all these. And then with the broker deposits, you're not opening up a bunch of accounts. You're not doing any of the anti-money laundering screening and things like that you might be doing with opening individual time deposits. So when you're looking at all of these, you just kind of got to weigh the pros and cons and look at the situation, which brings me to asking Long, when you were a CFO with those 5-6 banks over the last 20 years, how did you decide, okay, which one am I going to do right now?
Great question, Brian. And so, FHLB advances, so that you have two components to that. You have the term, and then you have the overnight. So if I were to need some additional liquidity right away that day or the next couple of days, obviously that FHLB advance makes a lot of sense, because I can just pick up the phone, call, and get those funds overnight. That makes a lot of sense. But if I were to need it over a 3-month, 6-month, 9 or 12 months. I mean, I'm not going to do overnight. I'm not going to pick up the phone every day and do this. I'm going to go to my broker deposit because I can then have the flexibility over the next, 5 to 7 days to get this term funding that I need. And then that way I can preserve my, borrowing capacity, my pledgeability of the assets, because that is so dear. And then I could use that in a much more strategic sense and in terms of if I have a liquidity issue, I can pick up the phone and do that overnight. But long term, 1, 3, 6, 9, 12 months, even 5 years, broker deposit makes so much more sense. Great question, Brian. Thank you.
Yeah, thanks for helping us with that, Long. It's good to have like a real life CFO on here. Thank you.
It is nice having a team member. So for those of you that just to let you know who the panelists are here. So Long does head up our consulting and risk management practice, but he spent the first 20 years of his life as a CFO and CPA in an operating role. So he is a resource, and he's your resource to the extent you ever want to call into Finance 500 and chat just about that. Good. Any other comments on that one, Brian, or are we good?
No, I think we can. The next slide kind of wraps up some positives.
Yeah. There you go.
So just an overview of maybe the 5 best reasons or something to consider broker deposits or to use them, from time to time. They're non-withdrawable. So these deposits cannot leave the bank. There can't be a run on the bank with this portion of your deposits. The only instance where they could be withdrawn would be in cases of death in an individual account, or rare cases of court deeming someone incompetent to act on their own behalf. And so really these are stable. Back to that hot money thing, they really can't leave the bank, unlike a core deposit or a time deposit, which really those people really chase rate too. The other thing is no collateral required. I think Long really drove that point home twice. So that's a plus. Flexible in terms. There's call features. We can go anywhere from 1 month out to 25 to 30 years. And we can stagger issues to mature at different times. We've had instances where banks come to us and say, I want odd numbers because I'm matching these to loans at different times with different maturities, and I want them to be callable, and we match those perfectly. And then if the loan was paid off, they called the CD and they unwound the whole thing. So we can be flexible there and do that. Again, not hot money. The rates are really prevailing market rates. When a CD matures, it is very simple to replace it with a new CD of like or kind time and volume at prevailing market rates. That would be the same with any time deposit you do. And then if you look at the last one, there is no marketing, there's no advertising costs, there's no personnel to open accounts, there's no compliance, and we do all that. And so those are some compelling reasons to have it as your, in your contingency funding plan and to issue from time to time.
Right. Thank you, Brian.
Yeah.
And now this is kind of switching over to just some basic scenario reviews. Jamin's probably going to forget more than any of us will ever know about, broker deposits, its activity, its movement, its market conditions. We've asked Jamin to walk us through 2 or 3 scenarios so that you get a real sense of what's going on in the market today. And so, Jamin, if you wouldn't mind, I think we'll start with how about a 1-year callable?
Yeah, thanks, Jeff. Thanks, guys. So this issue is live in our system right now. It's a 1-year issue. Bank is looking to get about 30 million is kind of like their desired cap. We price this specifically with a call option in it, even though it's a short-term 12-month issue. The bank wanted the flexibility that if something happened with interest rates, with volatility at such highs, things can turn on a dime. So they wanted the additional optionality embedded in the term to cancel the issue if rates were to go down rapidly. And they didn't want to pay much of a premium to get that option. They just wanted to ask, see if there was a way that they could get that embedded. It's a shorter term, but we've been having really good success with these shorter term callable issues. And believe it or not, it's the only 1 year callable issue in the market right now. And why it's attractive is the all-in cost. So you notice we're doing a 539 all-in. Today in the market, there are 9 1-year bullets at the same rate at a 530 coupon. Behind that, there's about 15 5.25 coupons. So the prevailing rate for 1-year bullets is around that, anywhere from a 535 to a 540 on the all-in cost. Those are just for straight bullets. This is a 1-year callable. And as you can see, it's a 539 all-in. There's no premium really. It's only about 5 basis points of a premium to embed that call option. So it makes it a very cost-effective structure to have that embedded flexibility. So callables, the way they work is at the first call date, which in this case is 3 months after it settles. So September of this year, they can call it in full. And there's no additional cost to call it. There's no additional fees. We just write up an intent to call letter template, which you fill out, submit to DTC, and then you can cancel the CD. We just have to give them 15 calendar days notice on the call. So if you notice, call provision is November 22nd of 2023. After that date, it can be called every month thereafter. So it's a continual monthly call. And again, called in full, very simple, but it's pretty much a no cost, easy way to get some balance sheet flexibility. And if things do change with the interest rate environment, to be able to get out of this issue and refinance at a lower rate at whatever the market rate is. So really good if you get any prepays on loans that are being matched off. A lot of banks are using the call option to match off with callable agencies, and they want to have the like optionality to pair it off with or match it off with. So this one's a really, really good, attractive one. We can do a lot of them. There's not a lot of issuance there in the market right now. So if any banks want to test the market, even with a little bit of a lower rate, we can probably have some success at getting some volume done.
Right. Cool.
And this one, okay, is a 7-year bullet. And why we wanted to highlight this one is the coupon rate and the all-in rate. So it's a 4.25 coupon. We just talked about 1-year bullets paying 5.25, 530. So this is a 7-year bullet. This is a non-callable. This bank wanted to get about 15 million. They wanted guaranteed placement of 5 million. So we're gonna wind up doing on this one close to 15 million, probably around 12. They were okay with 5, but this one moved really well, and it's 100 basis points below where 1-year bullet issues are pricing. So a very significant cost savings. And I believe this bank is layering that in just to be able to increase interest rate margin on current assets. This bank is actually doing a 6-year, an 8-year, and a 9-year with us as well, and they're all moving well. So we wanted to dispel any myth that just because the rate is so much lower on the longer terms that they don't get any traction in the market or our buyers shy away from them. They don't. We're getting very significant, very good volume, strong volume on these longer term issues. If you compare it to the 7-year treasury, right now, the 7-year treasury is around a 417, 418. So it's only pricing, 8 or 9 basis points over the going 7-year treasury. So very tight spread to the treasury. Totally fine issuing a low rate in the market. It doesn't look like the bank is trying to, take advantage of anyone or anything like that, just because they're paying, banks are paying over 5% on 1 year. You can get money funded at 100 basis points lower. The inversion of the yield curve is very significant right now. And we do have some banks taking advantage of that. And we encourage any bank that wants to look at some lower cost of funding to go outside, go a little bit longer on the curve, and we can price some specific structures up for you. And then the last one that we're looking at here is a 5-year bullet. This is a non-callable. Again, it's a bullet. We're raising 85 million, and we're just about done with the 85 million on this. And what this demonstrates is the amount that's available in our markets. Liquidity is very robust. We can raise, this bank is getting in a total of 170 million from us. They're doing a 4-year term as well for 85 million. Just in the month of June, we raised the bank 588 million in long-term bullets. That was long-term, 2 years to 5 years. Just in July, we raised another bank in Indiana, 350 million on, again, 3-year to 5-year bullets. So size is accessible in our market, and we can get you the size that you're looking for. If it seems to be something that might be a little bit insurmountable, it's not. We can raise a bank $1 billion if we need to. It's just got to pay market rates, probably do 2 or 3, 4 different structures. And if they're priced right, we can get that funding done. So some of the larger issuers out there that might not think that the liquidity is there, or whether or not Finance 500 could bring them that volume, we can. It just needs to be priced appropriately, in which we're more than happy to walk you through any scenarios that you're looking at, whether it's callable structures, bullet structures, short, long term. We can really customize it to your balance sheet and what you need to match off on the asset side.
And Jamin, it's probably worth mentioning, to your point. I mean, for our clients, it could be $1 million, it could be $1 billion, and we have the capacity and the response to do either. I think the important thing is that we have the capabilities, because of our performance management group, to align your funding needs with your strategy. We take the extra time to work with you to figure out what is the role of an alternative funding source versus just generically coming in. So we have the capabilities to help you. There is no predisposed number of what your broker deposit number should be. One of the questions, or if you don't mind me jumping in on this one, Jamin, we got a question. It's what's the range of broker deposit to total funding percentage that you typically see at banks? And I think we could all answer this from our own experience, but it depends. Some banks, it might be 2%. Now, certain banks, it could be 70, 80, 90%. But the point is, when you look at percentage of broker deposits to total funding, it really has to do with your business model and your strategy. And it comes in a lot of different sizes. We do have a good number of banks that are fast growing banks. And that's typically one of the things we see with broker deposits, that it just meets their funding needs to maintain the level of loan production they're driving. With others, it's a diversification strategy. And with others, it's the nature and condition of the market they're in. They could be in a mature market where lending is strong, but deposits have waned. Deposit opportunities have gotten smaller, and they continue to fund that business through alternative sources in a cost-efficient manner. So I guess my point is size or volume is subject to your strategy. From a capacity standpoint, we're agnostic. We can go high, we can go low. Sorry, Jamie, jumped in there on you a little bit. Maybe you could just, I know you have something to say about just current rates and what's going on today.
Yeah, thanks, Jeff. One thing I'd like to point out too is, and I think Brian touched in on it, is we're very flexible on how to structure any issue. We can be flexible on the settlement date, when the funds actually come in. We can be flexible on the maturity date, right down to the month and the year, if there's something very specific that's being matched off with. So an odd term, staggered settlement dates on callable structures. We've even been able to break up issues into 2 different QSIPs or even 3 different QSIPs. So if a bank's looking for 30 million, we can do 3 QSIPs at 10 million each. And what that allows the bank to do is, if they want to call a portion of that tranche, they can. If they want to call 2 portions of that tranche, they can. They don't have to call all 30 million at once. So we encourage any of our potential issuers or any banks that are looking at potentially bringing in funding, really test us to see what we can do on the customization of what your needs are as far as term, settlement date, maturity date, so on and so forth. What I'd like to point out,
up against our time, Jamie, so I'm not looking to shotgun you. I'm just going to let you know as we're just butting up against our 45 minutes. We all had a lot to say. So by all means, take us through the compass.
Okay, so this is the funding compass that went out just today. It just gives you kind of an overview of the market, what's happening in actual real data time, what's happening in the CD market with QSIPs and issues. We give you a little bit of a perspective on the economy and what we're seeing in our market. One thing that I like to highlight is the callable issues that have the longer lockouts. So if you look at the 5-year, no call 2.5-year, the 7-year, 3-year, and the 10-year, 3-year, you can see the difference in pricing and how much you save by going with a little bit longer of a lockout. The longer lockouts allow a bank to match the shape of the curve because we're going out a little bit further. We're not having to compete with 6-month and 1-year issues, which is how these are priced. They're really pricing to the short-term part of the curve. But the longer lockouts allow you to save a significant amount. If you notice on the 10-year, there's a 25 basis point difference from the 1-year and 3-year lockout. So if a bank, an issuer likes the 10-year final, but is okay with not being able to call that CD after 3 years, and then it's a monthly call after that 3-year continuous, take a look at the longer term lockout. As you can see, you can save a lot, increase interest rate margin, increase spread.
Great, thank you, Jamin. And for those of you that are joining us today that aren't receiving the Compass, it's just something we issue to all banks, and feel free to request it. I think it's the only single tear sheet that's in the market that is 100% dedicated to the broker deposit market. So just want to let you know that's out there. Thank you, Jamin. Hey, I know we're butting up against the clock, so let me bring us to our Q&A. From a closing thought standpoint, broker deposits have been a useful tool to support liquidity and contingency funding strategies for decades. It's not something new. When you analyze broker deposit trends, banks with broker deposits tend to perform well. So this myth that somehow it's associated with a troubled environment just is incorrect. Broker deposits are not a reaction to market conditions. They're part of a strategy. And I think what we're seeing in today's uncertain world, having a certain stable funding source makes good strategic sense. And in today's complex market, we certainly believe having a broker dealer that understands your business and can advise on policy, strategy, and risk management is an edge. And it's something that we hope people seek us out for. Just to let you know, and then we'll wrap up with question and answers. We do want to put something out there for all of you that are joining us today. If you've never issued before, give us a call. We'll take you through a test exercise. One of the things Long pointed in his most recent guidance from the regulators, they want you to exercise your alternatives. And if you haven't had an opportunity just to do a simple issuance, we specialize in that. We can walk you through that. We'll take care of it. You can also carve out some time with our CFO desk and really talk about your business model and what funding means to you. That we have an infrastructure to be your advisor. And certainly we also have an analytics platform. And if you want to have access to go in and use our analytics system, it's yours is on an unlimited basis. If you're issued but not a customer, we want to offer you our help desk again, and come in and talk to our guys if you want to talk about contingency funding planning, liquidity risk, interest rate risk, or a deeper dive in some of our competency areas. Give us a call. We're here for you for that. That's what we do for our clients. That's what we do for banks. And everything doesn't have to cost something. Partnering is being there at the right time. And you also having unlimited access to our analytics platform. Now, for our existing folks that are with us, if you don't know we have the one-on-one sessions, we want to let you know they're there for you. And we certainly have the analytics for you. But one thing as a client, when you take a look at our programs and ERM strategy and capital planning, as a client, you get material favored nation consideration for all our solutions because that's what partners do. So we just wanted to let you know that as we wrap up. I do want to answer a couple of questions. I think we answered the question about total deposit funding as a percentage. Long, I think I'm going to throw this one at you. We do have a question. What is the additional cost via FDIC premium that you assume? I assume it's 20 to 25 basis points. That was the question.
That's a great question. And so if you recall, the FDIC assessment is built on a quarterly basis, built from your call report. So basically, when you file your 630 call report, the assessment is driven by 331 call report data. So there's a delay in that, but there's two major components to the FDIC assessment. One, it has to do with your CAMELS rating. So when you go through and look at your CAMELS rating, for example, if it's a credit or the credit or if it's a management, if your score is a 1, well, the 1 is going to be 5 times less than a 5. So there's that component, but then the other component is your overall composite rating as well. in terms of everything else that the regulators give you. And that composite rating is built on a percentage of your asset quality, your assets, I'm sorry, your assets. So as your assets grow higher, that assessment gets to be more. So when you look at your assets, when it goes up, you have to tend to look at the balance sheet, and then when you look at the liability side, if it's a deposit, well, when you get a deposit, it impacts your liability, but it also impacts your cash, which drives your assets up. If you look at FHLB or even a broker deposit, those are components that drive your balance sheet up because it affects your cash. And so when you look at it, it's assets minus equity. So basically, there's no difference whether it's a deposit, an FHLB, or even a broker deposit, because it's built on your asset size.
Right. So the distinguishing feature here is there is not a premium vis-a-vis FDIC premium associated directly with broker deposits.
Correct.
Right.
But the one thing is that you want to, so again, your CAMELS rating dictate a lot of this. Is the lower your CAMELS rating, a 1 or 2, gives you a much more strategic advantage than a 4 or 5, because you're paying 2 to 3, if not 5 times more. That's one piece, but there's an overall composite rating that's built on asset quality, your assets, less your equity as well. That was something that was changed about 4 or 5 years ago as well. And so no distinction whatsoever. Higher assets, higher premium, higher assessment. But overall, those if you look at the assessment, they've come down quite a bit for community banks in general. So if you were to go and look at your quarterly, invoice, you'll tend to see that most community banks in general are only paying about 7 to 8 basis points on the deposit or the borrowings or any liability.
Well,
Good question.
Great insight. I'm going to need to catch up because we've run a little long. We want to thank you all for joining us today. We hope you found it useful. I do want to kind of close on a piece of information that because our brand may not be a household word out there, I think it's important that you all know that Finance 500, when it comes to tracking the unique CUSIPs, which are the issuances of broker deposits, we're consistently number 5 or 6 in the market. If you look at where we are kind of month to date in August, we're number 2 in the market. This is what we do. We're specialists at it. Whether you're a first-time issuer or you're a seasoned issuer, this is what we do. And if you want to get supported by those that are best at what they do, take that plus our professional service group. I think you're going to find great comfort in working with us in this area. At this point, I think we covered our questions and answers. We would love to hear from you directly if you'd like to go into a deeper dive about liquidity risk and your specific scenario. But on behalf of our executive team that's been on the call with us today and the company itself, we thank you for taking time out of your busy schedule. We hope to interact with you in a more personal area so that we can play a more critical role in supporting your success. Thank you for taking time. Meg Gomez is your primary contact. If you want a copy of this presentation or set up an appointment with our help desk, give Meg a call. She'd love to hear from you. Thank you, team. Thank you, attendees.